This session is focused on the new scenario comparison tool. So we're going to be creating a series of projections and then comparing them in order to unlock insights that we can then share with our client in terms of recommendations. This financial planning session has been reviewed by FP Canada and it qualifies for one FP Canada approved CE credit. It also, as a result of that, is eligible for one CE credit for MFDA licensed representatives for professional development. I know that MFDA has transitioned to CIRO and there's a new mapping. They refer to it as CIRO MFD CE. We have not seen that on our side in terms of the credit approvals and whatnot, so we'll continue referring to it as MFDA for the time being. And whenever that official switch takes place, we'll update the terminology used on the certificate. If you have any questions during today's session, please feel free to submit those at any time. You can use the GoToWebinar questions portal. So if you click on the question mark and then type in your question, we'll be able to answer that live. If we're not able to respond during today's session, we will get back to you by email within the next few days. Once again, in terms of the CE credit, 2 hours after today's session, we'll be sending out an email and that will have a recording to the session as well as a link to submit your full name and email address for us to send your CE certificate to. And once you complete the submission, you'll receive a personalized CE certificate by November 30th. As a note, the CE certificates are only available for live attendees. So if you are watching the recording, that won't be an option at this stage. We're going to be creating a series of projections today and then using the new scenario comparison tool in order to either summarize a single projection in order to understand the assumptions and the outcomes, or to compare multiple scenarios to one another and get a sense of the differences in what's happening in each plan and which one is going to be best for the client. And then we'll show how you can compare two scenarios in order to identify the differences between specific variables and their outcomes. And then we'll show how you can download files and share those insights with your client in a digestible and actionable way. Again, you can submit questions at any time, but we will have some dedicated Q&A at the end of the 1 hour session. While you're using Snap Projections, you can click on Help at any time in the top right corner in order to access our help resources. The Help Center provides access to all of our articles, videos, webinar recordings. As well, this is where you can find our contact information. So if you ever want to give us a call or send us an email, we'll be able to help on a one-on-one basis, either with general questions or by reviewing a specific projection that you're working on. With that, let's jump into the software and start creating projections for our couple. We're going to click Add New Client, and then we'll start entering in their personal information. We're creating a plan today for a couple, Sophia and Daniel Cruz. Sophia was born 1964. Oops. And they currently live in Ontario. I'll click Add Spouse and enter in the information for Daniel. He was born 1962. In the top left corner of the software, you'll see that there's 3 main sections to the tool. There's the scenario setup, which we're progressing through now. This is where you enter in things like general plan data, expenses, incomes, assets. Typically, once you're done this data input flow, you would then go to planning pages where all of that information comes together to show your client's life on one page. From here, you can then edit values and update information before proceeding to the client report in order to create a customizable PDF. You can navigate in between these at any time. So if you want to make an update on the planning page and then go to the client report or jump back to the scenario setup, you can just click on any of these to navigate back and forth. For now, we'll continue on with this scenario setup. I'll click Next and we'll go to the general settings page. The first thing I want to do is change the start year for this projection. Because we're so close to the end of 2024, I'm going to start the projection as of January 1st, 2025 in this case. That allows us to remove the last month or so from the projection and ignore any remaining transactions or account balance updates. And we're just going to start with everything assuming that it's the value as of January 1st, 2025. Their target retirement age is 63 for Sophia and 65 for Daniel. So I'll update those here. And we're going to run the projection until age 98 for Sophia and 100 for Daniel. For inflation rates, I'm going to use the FP Canada guideline assumptions. And then for rates of return, I've taken those same FP Canada guidelines and then reduced them for expected management fees. So I've entered in the net expected rates of return here. I'll click next and go to expenses. There's quite a bit of flexibility in terms of entering expenses in Snap. You can always leave this page blank and then use the planning pages to help calculate what these values should be. You can either use the sustainable spending tool within the recommendations, or you can use the calculated discretionary cash flow that the client has as of today. If you know what the client needs in retirement, you can enter that value here. So in this case, we're going to provide $90,000 of after-tax inflation-adjusted income. And then we're going to enter in some additional itemized expenses. So they want some additional travel of $15,000. We'll link that to the general inflation rate, and we're going to run that from age 63 for Sophia until age 74. And we're going to highlight that so that it's itemized within the chart legend. They also want to provide a gift to their kids of $50,000. And in this case, we're not going to inflate that figure. We just want to clean $50,000, and we're going to do this in the year that they turn 65. So we'll enter in 65 for both the from and to, and that's going to just do 1 year's transaction of $50,000. We'll click next and go to the incomes page. Sophia is currently earning $110,000, and we're going to index that with inflation for cost of living adjustments over time. It's being entered as employment income, so Snap will deduct CPP and EI. It's going to be taxed, earn RSP room, and then it's going to run until the end of the year that the client turns 62. If you want to prorate the income, you can click on this black gear box in order to enter in a specific date to end that income. This is common throughout Snap, where typically for a simple approach, you can just enter in the age, or you can enter in a specific date if you want to prorate values. We also recently added the option to enter joint income. So if your client has joint rental income, as an example, you can enter that directly here, and then it's going to split that income between the two spouses. Sophia also has a defined benefit pension plan that's going to start at age 63 for $35,000 with a 67% survivor benefit and no guaranteed indexing. Once she turns 65, the bridge benefit drops off, and she's expecting $28,000 a year from that point forward. In the top left, I can click on Daniel's name in order to go to his income input. He's currently earning $105,000, and we're also going to index that for the general inflation rate. You can toggle back and forth between the client's pages in the top left by clicking on their name. I'm going to click next and go to the assets input. Snap adds a non-registered account to each projection as a default so that there's always somewhere to allocate future surpluses. So if the client sells their home in retirement, or if there's more cash flow coming from the RIF minimum than needed for spending, Snap can allocate that into a financial asset. If you're entering in a non-registered account for the client, you can either replace the default or delete it and then add a new input. So here I'm just going to call this joint cash with a value of 25,000. Joint, yes, and then 100% allocated to cash. Sophia also has a tax-free savings account with 110,000, and that's invested as 40% fixed income and 60% equity. And Snap pre-populates the general rate assumptions that we provided previously. We can customize these on an account-by-account basis if we want by just clicking on the rate of return and making an adjustment. And then Snap is calculating the blended portfolio return for each account separately. Sophia also has 325,000 in an RSP that is similarly invested as 40%, 60%. So those are her three financial assets. Across the top of the table, you'll see that there are tabs for each of the registered account types. So if I click TFSA, I can enter in the contribution room starting next year. In this case, she has no carry forward room, so we're just going to leave it as the new room that will be earned January 1st next year. For RSP, it assumes 1 year's worth of contribution room available. I'm going to update that to 25,000 for Sophia. And that's all the settings that I'm going to adjust in this case, but there are other settings available as client needs permit. I'll click on Daniel and we'll go to his financial assets. You'll see there's the default account for him as well. I'm just going to delete that row since we already have a non-registered account in the plan. He has a TFSA of 110,000, a group RSP, and that currently has 430,000. And then he has a personal RSP with 120,000. Once again, we'll go through each of the applicable account tabs. So leave the TFSA contribution room as just next year. For RSP, he has 27,000 room. And then we can go to the employer matching tab where we can link his group RSP to his employment income by clicking on not selected and then employment income. And then we'll enter in 5% for both employee and employer contributions. Now that we've entered each of their financial assets, I'll scroll down and input the home, which has a current value of 750,000 and an original cost of 450,000. All right, so next we'll go to the debts page. I'll enter in their remaining mortgage, which has a current balance of 445,000, interest rate of 5%, and monthly payments of 1,600. I'll set that to joint, and then I'll link that to the home so that if we sell the property prior to the mortgage being repaid, Snap is just going to repay that in the same year as the transaction. And then the last page for this scenario setup, we're going to go to government benefits. We're going to start with CPP at age 65 for our base projection. So I've updated that here. You'll see that Snap automatically assumes the client will receive the national average, which is 55% of the maximum. You can either enter in the annual retirement pension if you have a Service Canada statement, or if they're already receiving their CPP, you can input the dollar value here. Otherwise, you can enter in an approximation based off of their employment history. So I'm going to use 80% as the assumption for Sophia. OAS we'll leave as 65 for the start and 100% of the maximum. I'll go to Daniel and make similar adjustments, so 65 for the start age. In this case, because Daniel is working right until he turns 65, we're going to assume he'll receive 85% of the maximum instead of 80. On the left, you'll see that we do have additional pages available that can be used as needed. So you can enter in insurance policies, conduct life needs analysis to see if more insurance might be required, add RESPs, customize a wide range of settings, or add corporations to the plan. But in this case, we're all set. We're going to click on planning pages, and that's going to show how all of this information that we've entered so far can come together to show Sophia and Daniel's life on one page. I'm just going to take a quick pause. I want to see if there have been any questions come in on the scenario setup section. Anything that comes to mind.
Hey, Steve, I mean, your plan looks great already. We don't have any specific questions right now, but just want to remind everyone that you can ask any questions based on what Steve is working with or anything else that you think we can answer at the end of the webinar. So nothing so far, but thank you.
Perfect, thanks. All right, so we're now on the planning page, which is one of the most powerful sections of the Snap tool. On the left, we have the year and our client's age if they're going to turn that year. Then we have the calculated discretionary cash flow that is left over from everything else modeled in the plan. So this 135,000 base expense figure has been calculated by SNAP by taking the total employment income of 215,000, subtracting off their tax and CPP and EI premiums, subtracting off the employee portion of the group contributions, and then subtracting off the mortgage payments. So this is net of all of those transactions, how much the clients have left for other spending or savings goals. If we wanted to, we could adjust this value in a couple different ways. The first would be to turn on the cash flow management right from the first year of the plan. You'll see right now it's set to turn on as of retirement. That's the default in SNAP. If you wanted to turn it on earlier, then you could set a target spending, such as this 90,000 figure, and then SNAP would automatically save anything remaining into the client's financial assets. The other way that we can adjust this is by entering transactions on the planning page, and SNAP will then adjust the calculation. So I'm going to go to Sophia's personal planning page, and then I'm going to input her TFSA contributions. So right now she's maxing out her TFSA each year. I can do that quickly by just entering in a value larger than the maximum each year. And then when I click Run Scenario, SNAP is going to check that contribution against its logic, and then it's going to correct the value down to the expected maximum. I'll do the same for Daniel's planning page. So I'll scroll over to the TFSA, enter in 10,000. And then you'll see that the Run Scenario button has turned red, which means that the page has not yet been recalculated. And that just allows me to make as many updates as I want with the current numbers reflected prior to recalculating everything. So I'm also going to contribute 6,000 into the RSP each year going forward. And this is his personal account on top of the group contributions. So now that we've entered in those contributions, if we go back to the combined planning page, you'll see that the base expenses is now updated. So it's showing 116,000 instead of 135, because that's the after tax, after contribution amount that will be available for spending. With any of these sections on the planning page, you can expand them in order to get more information. So for instance, if we want to see how this 215,000 total employment income was calculated, we can expand, take a look at the two values. If you hover your mouse over top of the column title, you'll see that this one's for Sophia and this one's for Daniel. Similarly for tax, we can expand that and see the breakdown between CPP and EI, as well as total taxes. Once we reach retirement in 2027, you'll see that the cash flow management is turned on by default. We have our target spending of 90,000. That's being indexed forward for inflation. We have our travel budget kicking in. We have our gift to the children. And then we have our sources of funding. So we have the pension plan, government benefits, and then SNAP is automatically withdrawing from the financial assets in a tax efficient manner in order to reach the total spending need in the plan. If we scroll all the way to the bottom, you can see as of 2062, the final year of the plan, they have just a little bit left, 94,000 in the RSP. So they're right on track for their target retirement. We can also review this in the form of charts. So if I click on that in the top right, you can see a breakdown of the different spending. So base expenses, additional travel, the gift to the children, taxes. If we scroll down to cash inflows, we can see where all of that money is coming from each year. And then we can see how much the client has available in various assets. And all of these charts are fully interactive. So if I click on these values in the legend, I can remove or add them. And that just facilitates a lot of variable conversations that you can have with your clients. All right, so we're now done with the first projection for Sophia and Daniel. We've been able to confirm that they are on track for their target retirement, just based off of the default assumptions in SNAP. That creates an efficient plan. But what we want to do next is see whether we can help them to have even more funding available. So are there tax or government benefit strategies that we can implement in order to improve their situation? So I'm going to copy the plan, and we'll create a second scenario where we start to change the assumptions, and then we will ultimately compare those outcomes between the two options. And while I'm getting the title updated, I'll just pause and see if there's been anything that came in on the first scenario.
Thanks, Steve. So we have one question that I think we can address is the group RSP that you added under Daniel. Does that RSP contribution that's happening from the employer coming from the income, or it's additional to the client's income?
Great question. The employer portion is considered to be separate from the employment income. So for instance, right now we have employment income of 105,000 plus they're receiving the employer portion of the contribution. So technically their total taxable income from the employer would be closer to 110,000. But then of course the contribution to the group RSP offsets itself from a taxable income standpoint. So it really just nets itself out from the plan. It's not adding taxable income and it's not impacting the cash flow. It's just increasing the account balance each year.
That's awesome. Thank you.
Awesome. So now we have our scenario 2, and we're going to go into scenario setup, government benefits, and then we can adjust the CPP start age from 65 to 70. Now, I want to mention something important because this is a more and more common step that people are taking in the software and in general, recommending deferring government benefits. And so I just want to mention a couple of factors that play into the calculation of how much a client is going to be receiving. If I simply defer the CPP start age from 65 to 70, you'll see that the dollar value automatically increases. But this increase is both for the 42% deferral bonus, but it's also increasing as a result of the gradual phase-in of the enhanced CPP. So for the next 40 years, roughly, the maximum CPP benefit is going to increase each year at a faster rate than usual because new recipients have contributed into the CPP enhanced contribution program. If your client is retired already and you're deferring government benefits, they will not receive those additional enhanced increases. So what we want to do instead is when you're deferring from 65 to 70, if the client is going to be retired during that period, you can take this value of 14,194 and just multiply that by 1.42. So we're just going to separately increase that by the 42%. That's going to bring us to a value of 20,156. And so we can change the start age to 70. You'll see that if we also include the CPP enhanced contribution increase, it's assuming that they would get 21,363, but they're only going to get 20,156. So you can make that adjustment here. Another way that you can do it quickly or approximately is by simply reducing the percentage of maximum that the client is going to get at age 70. So you'll see right now we're assuming they're going to get 80% of the maximum. If we defer to 70, we can just reduce that by 5%, and that's going to approximate the calculation for just the 42% increase. So either approach works. This is just a quick approximation, or you can multiply the original value by 1.42 or whatever the deferral benefit will be and input that dollar value directly. And that's just going to make sure that our comparisons and recommendations are as accurate as possible. If you do have additional questions, we have articles related to the CPP calculations, and we're always happy to help talk through any client plan that you're working on as well. So now that I've made that adjustment for Sophia, I'm going to go to Daniel, set the age to 70, and then reduce this by 5% to 80%. Now we can go back to the planning pages to see the impact of the CPP deferral. So if I go to combined, in the government benefits section, I can expand that to break out CPP and OAS. And now you'll see that it's only starting to phase in once they turn 70. And then if we scroll all the way to the bottom, as of the final year, they have about 400,000 left in this case, which is much more than the 80,000 in the previous scenario. So the deferral is quite advantageous if the client ends up living all the way until age 98. We can also copy this scenario and then try deferring OAS as well. So by breaking up the changes, we'll be able to see the degree of impact that each change has on the plan. So I'm just going to update the title. So this will be scenario 3. go to scenario setup, government benefits. And in this case, I can simply change the start age to 70 because OAS doesn't have that enhanced component. The calculation is the same no matter what the client's circumstances are. So I've changed the start age, go back to the planning page. And now I can see under the benefits that there's nothing being received for the first 5 years of retirement. And then if I scroll all the way to the bottom, we now have 551,000 as of the final year instead of 400K. So slight improvement, but still an improvement. Another consideration that we might have is now that we've deferred a lot of taxable income for the first bit of the plan, we have very little taxable income and taxes payable as the client starts retirement. So another thing that we could do in a fourth scenario would be to to start registered money withdrawals earlier in order to take advantage of those low tax brackets. So I'm going to create scenario 4. And the way that I can convert RSPs into RIFs as of a specific year is I can go to the assets page and then click on the RSP/RIF tab and then change the conversion age. So for Sophia, I'm going to convert at age 62 so that it starts withdrawing right away at 63. And then for Daniel, I'm going to convert his 2 accounts at 64 so that they come online as of 65. So now on the combined planning page, I can see that the taxes payable are a bit higher. So we're taking advantage of that low taxable income period. We have more money coming out of the registered account, so about 36,000 a year. And then if we scroll all the way to the bottom, we've now increased that final final financial asset balance to 600,000. So a slight improvement even yet. So now that we've created our 4 scenarios, we're ready to use the new scenario comparison. And you can of course use this tool with 1 scenario, 2 scenario, 5 scenarios. So there's lots of flexibility in terms of how to use it and interpret the numbers, and we'll go through each of those examples shortly. Another thing that I want to mention is this process of creating multiple scenarios can take time, and this is something that we're looking to automate in the near future. So today in Snap, or historically in Snap, we've been focused on creating lots of functionality and ways for you to model your client situations. And the next phase of Snap is how can we accelerate the process of creating and comparing scenarios so that you can get started with a high value, high impact plan as quickly as possible. So we will be building on top of all of this functionality in order to make that process easier for you. So I'll click on the 3 horizontal lines at the top of the page. That's one way that I can access the compare scenario feature. And then I'll click on that. And it's going to bring up my scenarios for the client and allow me to select anywhere from 1 to 5 scenarios. So I'm going to start by comparing all 4. And we get this really clean summary of what's happening between these different scenarios. So on the left, we have various customizable metrics. And then on the right, we have each of the accounts or each of the projections that we've created so far. So in our base scenario, as a reminder, we were starting CPP at 65 for each client. And in that case, they were just on track for their goal. They had a little bit of money left at the end, but it was really just a fully funded plan. When we deferred CPP and OAS, just CPP, we increased the surplus quite a bit, 5%. When we deferred OAS as well, you can see it's still an increase, but a lower increase. And this is helpful to understand because if a client's on the fence about deferring, maybe you defer just CPP and not OAS, because we can see that the CPP deferral benefit is higher and therefore it has a larger impact on the plan outcomes. And then finally, by starting the RIF early, we make an even further improvement. And so the goal progress is a quick way that you can digest the changes to the plan, but we can also see lots of other variables. So for instance, the personal taxes are changing with each of the projection. So when we get more government benefits, we're going to pay more taxes. And then when we take RIF early, we can see that we reduce the total lifetime taxes in that scenario. Similarly, for the government benefits, you can see that there's an increase across the way. One of the most common values to compare between scenarios is the estate after tax. The best way to think about this number, whether the client is worried about their estate or not, this is still a very valuable number because it's the amount of money that the client owns of all of their assets in a given year. So it factors in any taxes payable, and this just gives you a net figure of if the client lives, this is how much they have available on a continued basis. If they pass away, this is how much would be available for their estate. And we can see that it's improving across each of the 4 scenarios. You'll see that there are other metrics available. So some cases might not have a corporate estate. And so what you can do in the bottom left is you can click select metrics to include, and then you can uncheck any of the metrics that don't apply to your clients. So I'm just going to remove all of the corporate mentions. I'll click show selected metrics. And then if I want to make that change permanently for all of my future plans, I can click on the arrow and then click Save Current Metrics for new clients. And that way I'll just have a cleaner comparison each time. You can always add them back in, but as a starting point, it's going to have those removed. So this comparison right now is being run for the full projection. So it's the total value, like total lifetime spending of 5.4 million. That's running from 2025 until 2062. We can change the start age and end age of the projection if we want to do different analysis. So for instance, I could end the calculations as of age 90 and see whether there is a difference in the outcome if they were to pass away earlier. So now with an estate of age 90, we can see that the difference in the estate after tax is a bit lower. There's still an improvement across each of the scenarios, but the total difference between the 4 plans is much smaller. And that's because there hasn't been as many years for the increased government benefits to really pay off for the client. And this can be helpful to view the calculation in different years, but another great way to digest that information is from the trends option within the scenario comparison. So in the top left, I'm going to click on trends. And now we can see the number for each plan in each year. So here we have the base expense. Every year of the plan, you'll see that there's only one line because all 4 scenarios have the same assumed base expense value. This can be important to confirm because sometimes if you have differences in outcomes, maybe one scenario has more money in the final estate than the other, that could be because of a great strategy or a tax planning, or it could just be that they spent more in one plan than the other. And so that's not really a fair comparison because they're living different lifestyles. So if you want the base expenses to be the same and compare apples to apples, you can confirm that that's happening from this chart. The same is true about the total expenses. So this one also includes their additional travel budget and their gift to the children. We can see that the plans start to differ when it comes to personal taxes, and that's because if they're starting government benefits early or late, if they're converting their RIF early or late, it's going to have different taxable incomes and different taxes payable between each scenario. If I scroll all the way down to the estate after tax comparison, this is where we can see how the client's plan will compare each and every year of the scenario. And this is a very powerful section for analysis and to explain why you're recommending one approach over the other. So we can see here that in the first 2 years of the plan, there's no differences because we haven't made any changes to the assumptions for that working period. But then once they retire, we can see that there starts to be a bit of deviation between the plans. The base scenario where they're taking CPP right away is the preferred option. And that continues to be true for roughly the first 15 years of retirement. So we can see that the purple, the base scenario is preferred all the way until age 82, at which point you start to switch. And now having deferred CPP and OAS and started RIF early starts to become the preferred approach. And that continues to happen all the way until the end of the plan. So in terms of digesting this and helping the client pick one scenario over the other, you can think of a few things. The first is the relative difference. So here we can see that there's about $100,000 in difference between the worst case scenario and the best case scenario. So fairly large, but on a relative basis, they're fairly close together, right? It's about 6 or 7% of the total net worth of the client. Whereas at the end of the plan, there's a difference of about 2 million or 2.2 million versus 1.7, so a $500,000 difference. And so if they do live past their expected life, then these scenarios are going to be much better off than if they had taken CPP at the start age of 65. So we can look at the relative difference between scenarios. Another thing to consider is the probability of a client passing away in any given year. So comparing scenarios at age 65 is helpful, but if the client is unlikely to pass away at that point, it's less important. Similarly, yes, there might be a great difference at the very end, but if they're unlikely to live to 100, it's not necessarily something that you want to decide the plan on. Instead, you might focus on this life expectancy period of, say, 80 to 85, where the client is most likely to pass away, and see which scenario is going to be best in that outcome. So those are some things to consider when using these charts and comparing different scenarios. Another thing to consider is the option to display the information in real dollars. So right now, everything's been set in actual future dollars. You can illustrate things in real dollars where everything has been discounted for inflation. So that helps to kind of contextualize the differences. You'll see now the difference at the very end of the plan is less significant because while it's $500,000 in future, it's closer to $200,000 of difference in today's purchasing power. So whether you like nominal or real, you can toggle back and forth here. You can also select which metrics you want to include in the charts. So for instance, there's no corporation in this plan, so I can go into select metrics and I can uncheck any of the corporate related charts. I might also remove some of the repetitive information. So for instance, the personal estate net worth is just a subcomponent of the final estate. So I'm going to remove that, as well as the financial assets. I'll leave in the government benefits. I'll take out corporate tax, and then I'll take out the base expenses. Then I'll click Show Selected. And similar to the summaries, I can choose to save those settings for new scenarios. Once I've selected what charts I want to include, I can print this as a separate document. So I'll click Print. That's going to open a new tab and allow me to save a PDF of this information. So I'll click Save. Similarly, if I go back to Summaries, I can either export the table into Excel or print it as a PDF. Now, before I print this one, I'm going to make a small change. I'm going to click on Select Different Scenarios. So I can remove some of the scenarios that I'm not going to recommend in this case. So I'll get rid of 2 and 3. And I just want to compare 4 and our original base scenario so that I can show the difference in outcomes if they implement the strategies that we've recommended. So in scenario 1, they had 101% funding. Scenario 4, the recommended approach is 109, so a difference of 8. So we get this nice clean difference column if we're comparing 2 scenarios. And we can similarly see the estate after tax difference of 512,000. So now that I've adjusted that, I can click on Print, and then I can take a look at what the layout would be. So you'll see right now, this is spread over 2 pages because of the number of rows I have in the table. Now I have a couple of rows that are 0. There's no OAS clawback, there's no debts and insurance proceeds. So if I want, I can cancel that, go back into here, and just remove those from the chart to make it a little bit cleaner. So I'm going to get rid of any of the $0 values in this case. And because I'm not saving that as my default, the next time I create a client comparison, those will come back and show me whether they're applicable in that case. So I'm going to click Print. You'll see now it's just one nice clean page. I'll click Save. Perfect. So now we have our 2 separate exports, and we're all set with the scenario comparison tool. So I'll close out of here. And we'll go back into scenario 4, which is going to be our recommended scenario. The last thing that I'll do here is I'm going to go into recommendations, and I'm just going to calculate a couple of options that the client has for this overfunded status. So with sustainable spending, I'll click calculate. And you'll see they have about 5,000 of extra buffer that they could use if needed. And then I'll also click calculate under the retirement age. So in theory, if they wanted to, if they are okay having just the house as their buffer in the plan, they could retire 1 year earlier based off of all of the numbers in the projection. So I'm not going to apply either of these. I just want those calculated so that they can show up in the snapshot report. And now that I'm done with the plan, I'm going to go to Client Report. I'm going to go to Report Builder, where I can select what pages to include. And I'm just going to do a simple snapshots only summary. So I'm going to include all 10 snapshot summaries. That's going to be spread over two pages. And then I'm going to go through each of them in order to customize the information as needed. So I'll go to Report Editor. Here we have the goal summary, just outlining when they're going to retire, how much they're going to be spending. We have the assumptions. We have the goal status, 109%, and we have those two recommendations that we calculated on the planning page have been repopulated into this page automatically. Continuing on through each of the summaries, we can see what information will be included. And then once I get to recommendation summary, this is where I can input any of the custom text that I'd like to include in the report. So I'm just going to put a little bit of congratulations, explanations about next steps for contributions, and then outline that they'll most likely be best off deferring government benefits and starting the RIF early, but that we'll revisit those calculations closer to retirement to account for new information. So now I can click Done, and then I can click Generate PDF. So now I have my 3 documents, the report, which is a 2-page summary with the goals, some visuals, charts, tables, just a high-level overview of what's happening. And then we can also include the comparison chart and comparison tables in our analysis in order to illustrate why we're recommending one approach over the other. So for instance, we can have our summary table. And then we can have our trends. So here we just show different views and explain why we're recommending the ultimate scenario and what's happening in that plan. So that's an overview of the new scenario comparison tool. Again, you can access that from the 3 horizontal white lines at the top and then click Compare Scenario. You can also access it by clicking on the client's name and then clicking on Select Scenarios to compare. Or if you're back on the client's page, you have the option to click directly on the client's name here and then select the scenarios for comparison. So anytime that you're looking at the list of scenarios, you can select if you want to compare them or go directly into the plan by clicking on the name. So that's everything that we had pre-prepared for the scenario comparison tool. Before we jump into questions, I just wanted to mention 2 upcoming enhancements that we're going to be releasing in the software shortly, just so that you're ready for them once they're available. The first is related to debts. So right now, if you add a debt to the projection, you can enter in an interest rate, but that interest rate remains constant throughout the whole plan. So for instance, if I go to the planning pages with the debt, you'll see that the only thing that I can do is adjust the amount paid each year. This is different than financial assets, where I can actually click on the percentage rate of return and either change the rate of return or the asset allocation in any future year. So we'll be adding this rate capability to the mortgage or to the debt section shortly so that you can model things like mortgage renewals, variable mortgages, or other debts that you may want to change the assumed interest rate throughout the projection lifetime. So that should be available within the next few days. And then we'll also have an upcoming release within the next week or two. And that one is going to be related to the charts. So if I click on charts at the top, right now, some of the charts in Snap have the option to toggle to real dollars. So you'll see here, I can go back and forth between nominal or real, but not all of the charts have that option. So for instance, cash inflow can only be displayed currently as a nominal dollar chart. So we're going to be adding real to all of the charts throughout Snap, including, most importantly, the snapshots report. So now if you want the, for instance, the net worth summary to be in real dollars, you'll have that option to toggle and then include that in the report. So those are two upcoming enhancements. So with that, I'm going to open it up for questions. We'll see what we can tackle. And then if we can't get back to you today, we will get back to you by email within the next few days.
Thanks, Steve. I guess this is fantastic, and thanks for showing us all the scenarios. And also, we have had some really great questions come in from our attendees. So thanks for the participation. I had just one question that's really interesting. So if you could go around the navigation and show us how you copied a scenario, renamed it, and then went to the comparison scenario button quickly.
Yeah. So in order to copy a scenario, you'll go to the three horizontal white lines at the top of the page to the right of the scenario title. So black section at the top, scenario title, scenario menu. Once you click on that, you'll have the option to copy the scenario. And initially, that's just going to put the same scenario title with copy at the end. And there's two ways to adjust the title. You can either click directly on the title itself, which allows you to rename it. So I could call this scenario 5, example copy. Or I can click on the horizontal white lines and then click rename scenario from here. So a couple of different ways to rename it, but the main way to copy is from that menu option. Then once you have all of the scenarios that you want, you would click on that menu option again and click compare scenario. From here, you can then select anywhere from 1 to 5 scenarios using this checkbox system and then compare those selected scenarios. And if you do want any additional deep dives into the scenario comparison tool, or if you just want a quick video that you can refresh yourself from time to time, we do have some articles in the Help Center that refer directly to the comparing scenarios, and that'll have videos and some walkthroughs on how to set it up and how to model your plans.
This is great. Thank you so much. One more question on comparing scenario again. Is there any other way we can compare scenarios other than using those three lines from the top?
Yeah, so right now, you can basically compare scenarios anytime that you have your list of client scenarios available. So the most common is from the three horizontal white lines. The other option is to click on the client's name, or you can go to the clients page and then click on the client file. So any of those will allow you to compare directly or to access a specific plan.
Okay. And just one more question. When you were initially doing your inputs on employment income, you did show that we can prorate the employment income, maybe to start at a different year or a different time. Can we do it in some other inputs as well? And how can we go about prorating some of those sections?
Yeah, so let's do an example. So we'll just do prorated income. So right now, if we look at the planning page, the default logic is fairly simplistic. So we have our employment income for the full 2 years prior to retirement, and then we assume that the pension income starts right away. If we had CPP and OAS back at 65, so I'll just make that adjustment here. So If we put those back to 65, you'll see that those just start kind of January 1st of the calendar year where they're being received. So right now it's very kind of simplified, and it's not specific to when the client is going to retire. If we know when they're going to retire or what their target is, we can prorate a lot of these values in order to have partial income or partial pension or partial government benefits for the year. So if I go to scenario setup and then incomes, let's say that the client is going to work until halfway through the following year. So if I go to the to age of 62, I could change this to 2027, 06, 30. And that way it's going to create half a year's worth of employment income on the planning page. So now you'll see 2 full years of income and then a partial year of income. And we could also prorate the pension, the government benefits. So if I go into the pension, I can either prorate the amount by clicking no to yes. So that's going to prorate it based off of the client's date of birth. So it will assume that they actually start the pension when they turn 63. If I go to government benefits, I can click prorate first year of CPP or prorate first year of OAS. And that again is going to assume that they start that pension the month following their actual birthday. The other thing that I can do if I want to prorate is I could directly from the planning page override a dollar value. So if they're only going to get $12,000 of pension in 2027, I can just override that first year payment and then run the scenario. So those are some of the ways that you can get a bit more granular in your plans. Again, it tends to have a very minor impact on the overall projection. So as a simplified and default assumption, we kind of start things end of year and beginning of year. But if a client is more detail oriented or they know that information, you can model it in order to be more specific.
This is wonderful. Thank you. Just on planning pages as well, we had a question on our cash flow management, our default for accumulation and decumulation. If you could walk us through that as well.
Yeah, so if we go to the financial assets section for the client, you'll see Snap has the cash flow management turned on as of age 63. So it's trying to reach the client's target household spending goal. And it's doing that initially by taking money out of the non-registered account. Then it moves to the TFSA, and then it would take from the RIF based off of the cash flow needed. So in this case, it's taking the minimum because we converted earlier, and then it's taking the rest from their other financial assets. So this is what we refer to as the cash flow management order. If you want to change that logic, you can go to the teal blue box at the top of financial assets and then click show the CFM order. And that's going to add 2 new columns to the projection, one related to contributions, one related to withdrawals. So again, for withdrawals, the default logic is NTR, non-registered TFSA registered. This is based off of research that's been done by the FP Canada Foundation as well as CFA Institute, which suggests that kind of absent a deep knowledge of the client's goals and unique circumstances, a very efficient way to draw down on financial assets is to use up non-registered first because those have taxable drag on the growth, then to use up the TFSA in combination of minimum withdrawals from the registered account in order to blend taxable income over time, and then to use registered exclusively as late as possible in the plan in order to defer those taxes. So that's the first starting point, and it tends to create a very efficient base projection. But if you wanted to, you could change that logic. So you could do NRT, and you could leave the TFSA as the final account to be used in the projection. And then Snap's just going to adjust all of the withdrawals and then recalculate the numbers. So now you'll see there's no money coming out of the TFSA until the registered account is fully depleted. So you can use the cash flow management order. And another thing that you can do is override specific dollar values. So if you just want to take out, say, $4,000 a year from the TFSA, you could enter that as an override, and then Snap is going to work around that logic in order to take money out from the various sources. So now that we've entered 4,000, it's taking a little bit less from the non-reg to start. So those are some of the ways that you can change the cash flow management logic. This is a very popular topic related to decumulation strategies and what's the most optimal approach. This is one of our key areas of focus at Snap, is to help to automate a lot of this process so that we can try a lot of the different combinations and let you know what the best starting point is, so that you have the control and transparency that you do today with the time savings that automation can provide. So we're continuing to build out those automated accelerators.
Awesome. Thank you so much, Steve, for getting into the details of this. Just one last question, probably. What will happen if we have one of the spouse pass away earlier? Can we make changes to to their spendings or any other changes that we can address with that?
Yeah, so if we go back to the combined planning page for a moment, right now, as a simplified assumption, we have both clients passing away in the same year of the plan. If we wanted to change that, we would go to scenario setup and then general. And let's say that we have them both pass away at age 95. So that's going to have them passing away 2 years apart. So now that I go to the planning page, I have the option to adjust the base expenses in any year of the plan. So if I want the 90,000 to continue, I can do that and just have that spending continue, or I can customize the spending once the first client passes. So if I want, as of Daniel's death, I could change this 90,000 to say 45,000, or 70%, for instance, of this value and go with 63,000. So you can have different values. The one thing that I'll mention is if you change the projection length and a client passes away earlier, then you'll want to revisit what shows in this column by default, because oftentimes Snap will remove the deceased's spending assumption from the plan automatically. So if you want still the full 90,000, or you want to prorate that to a specific level, you would come to the combined planning page, go to the year of death, and then change these values directly.
Perfect. Thank you so much, Steve. I mean, we're almost up the time, so thank you for asking all the questions again to all our attendees. I think we're good, and we can probably wrap up the Q&A session.
Awesome. Yeah, so thanks again, everyone, for joining us. We really value your feedback on what's working, what's not working. We'll be sending out an email after the session just to gauge feedback. So whether that's on the content in the webinar or generally in Snap, anything that you share with our team will be taken into our tracking system, prioritized, reviewed, discussed. So everything is driven by your feedback, and we really do value understanding what you need in the software. So let us know. You can also send us an email directly at support@snapprojections.com. One more time, I'll just highlight the help resources. So if you click on help in the top right and then help center, this is where you'll be able to find a lot of great articles, videos, webinars. If you go to webinars, you can find all of our recent sessions. Some key highlights that we often share with clients are things like the help your clients get the most from their money in retirement. That's a decumulation strategy and modeling presentation. There's also creating quick and simple projections in Snap if you just want to get started and use the tool more often. And then you can search for any key terms. So if you're interested in modeling an inheritance, you can just type that in and find the article related to those transactions. So lots of great resources. And then if you ever get stuck, you can give us a call, send us an email, and we'll help on a one-on-one basis. But with that, thank you once again, and we look forward to the next webinar session.